This is Don Kaufman, and you are watching the TheoTrade evening video, November 7th, 2022. Just about 5 minutes left inside of a trading session that, hey, let's just not read too deeply into this. The price action is still very much within what we term the volatility box. More on that in just a moment. But one of the key things that has really caught my attention this evening, it's the bond market. I mean, are you watching these bonds? Look at this. Bonds down to the 118 and 17 tick handle. This is not a friendly marketplace. Down again, another almost full point. For those of you that do not necessarily speak bond geek, listen, the bond market, there's 32 ticks to a 1 point move. We're down between 29 and 30 ticks right now. It's another point off the bonds. Let me actually translate this for you. The bonds, they're approaching their lows of the year. And for those of you, again, if you don't necessarily speak what I term bond geek, you can always look over at the TLT. The TLT is the ETF, a friendlier, gentler, kinder version, if you will, of the bond market. But taking a look at the TLT, let me put it in perspective for you. Year-to-date percentage. It's now down approximately 35%. Just bear with me on this front for just a moment. Look at the QQQ. Which obviously, everybody's talking about tech stocks getting absolutely hammered. But taking a look at the Qs, yeah, the Nasdaq is only down between 33 and 34% presently. One of the aspects that, again, I can't get past this one. It's why I wanted to focus on it in this evening's video. The bond market's just getting absolutely annihilated. And at this point in time, like, if you think that the S&Ps are immune to it or the Nasdaq is immune to it, I mean, hey, look, think again. There's another way that we should actually put this into some perspective. And that's actually to look over here on Tasty. All right, so we're on Tastyworks, and you're looking at the 2-year. I can bring up the 10-year, and of course the 30-year. Now, if you've never really looked at this on Tastyworks, specifically on a chart, what you're looking at right now happens to be none other than the 2-year. It's the interest rate, okay? And this is presently trading at roughly 4.71%. Now, of course, if you take a look at the quote over here, it's quoted as 47.21. But what I love about this is it's precisely a year. I just opened up a 1-year chart, and we've moved from roughly, okay, 0.5% to 4.7. And it's not just cause for concern. When you're looking at, hundreds of percent higher, you're talking about the 2-year. I mean, the damage that's being inflicted, even if you saw this drop from, 4.7 and immediately drop back down to 3%, listen, the damage is already done. And so that's the 2-year. Not necessarily everybody's, familiar with the 2-year. And you hear these terms like, yield curve inversions and so forth. Listen, they're actually referencing in a yield curve inversion is that the 2-year is presently at what, 4.7. You look at the 10-year, it's actually dropped to, 4.18. I say dropped, but, okay, look, I'm just referencing the actual yield curve. So that 2-year is up here, roughly again at 4.7. Taking a look again at the 10-year, the 10-year is roughly, okay, 4.18%. I mean, that is just one wickedly inverted yield curve. But the cause for concern at this point, it's not about, the yield curve and the inversion, because it's been massive. It's at the point right now, okay, where, listen, rates are ready to break back out into new highs. Effectively, what I'm saying, new high interest rates. It's the 10-year that's really going to have the impact, if you will, on the mortgages. But look at the ZB. By the way, right, seeing some sell-side activity right into today's close. I mean, we're really right up against some of the closing lows at this point. And again, to kind of bring this into scope, we're going to trade right down to 118, possibly in some of the overnight trade and pre-market. You may see some bond lows. What point is that going to not just be cause for concern, okay? Once again, like, this is the trade that sparked, if you will, tremendous amount of sell-side activity early in the year, okay, in the Nasdaq. So it was a precipitous decline right after the beginning of the year into March and so forth that just panicked, if you will, some Nasdaq trade. And again, we're looking at a very similar time frame. The wild sell side activity that hit the QQQ, again, a lot of that being generated, if you will, inside of the bond market. Earlier in the year as well, taking a look here, there is the closing bell. But earlier in the year, again, the sell-off inside of the bond market sparking some fear. I think we're at the point right now, if you're not watching the bonds, you're not really seeing what's effectively going on. Now, at a week like this, of course, everybody's going to be talking about the election, but don't forget, of course, CPI. CPI is going to be absolutely critical because that's something that not only could spike the bonds, you could see actually some wicked sell-side activity. But the point being here, bonds are not waiting. They're not waiting for the CPI, which comes out, okay, Thursday. Speaking of which, the bond market is actually technically closed. That's the cash bond market is technically closed on Friday for Veterans Day. Please keep that in mind. So the price action that you're going to see in the fallout is basically going to happen between, Tuesday, Wednesday, and of course Thursday into that CPI print. All right, there's a lot of turmoil ahead of us, which actually, once again, brings me back to the S&Ps. If you're looking at the S&Ps today and you're kind of wondering, hey, he's not mentioning those too much, look at me. There's just nothing to mention today. We are right at the upper bounds, if you will, of what we term our volatility box. And this is often where I say, look, there's nothing to see here. We've seen this box kind of between 3,800 and 3,600. Now, I've put in a very, very specific level, and that happens to be right around 38.11 is the upper edge of the volatility box. If you take a look where we're presently trading, we're 38.14, okay? Again, this is, when you're 2, 3, maybe 4 points outside, okay, means nothing. And I will reiterate the stance. Being at 3,800 is the same thing as being at 3,600. When we're in the box, that's it, we're in the box. Okay, that's one of the key points to be made at this point in time. A rally, okay, could be explosive to the upside, could take us right back to 39.31 unequivocally, but that same risk, okay, has been there now for, really since what? Kind of mid-September. And with the bonds, okay, kind of getting rocked to the downside, right, an upside explosion is not cause for concern for me. I mean, I'm a little nervous that, we could explode to the upside only to turn around and get absolutely crushed. One last aspect worth mentioning in this market today, okay, of course, would be none other than volatility. Volatility. A lot of people right now are looking at volatility and like, wow, man, it's really fallen off. Listen, do not let this fall by the wayside. A 24, 25 VIX is still extraordinarily high, okay, relative to where it's been in like the last decade. And I think effective way to display that is, to display just that. Let's actually cruise back to a 10-year weekly in terms of VIX. Now, again, I'm not a big VIX, if you will, trader. In terms of when I say trader, I just don't look at the VIX as like a great indication of volatility in the overall marketplace, because frankly speaking, it just hasn't been a great indication. But to gauge, if you will, just where you are in terms of overall risk in the market, again, to point out, this 24.5, you kind of thinking, volatility has really subsided, and then you come to recognize that, listen, after the onset of COVID, it's just been, Mr. Toad's wild ride, no question about that. But in the previous, umpteen years, right, there's very, very few instances of volatility, okay, above that 25 handle. So at this point, when his volatility starts to subside, I think everybody kind of gets lulled a little bit into a false sense of security. Listen, this week, as I was saying on the weekend update, this week holds just about $118 in terms of expected move. I mean, that's, again, it's almost identical to last week's, okay, expected move. And last week actually held a Fed announcement. So to think that volatility, all right, is dead is, again, very, very misleading. I mean, we have a range to take us very close to 3,900. all the way down to about this 36.50 handle. Again, volatility absolutely unequivocally still with us. There's no read right now in the S&Ps just because we meandered a little higher. Okay, hey, great. It's the world kind of according to Apple right now. By the way, we'll talk about this more throughout the course of the week, but listen, Apple has become, if you will, its own index product. I mean, in terms of market capitalization, everything else just pales in comparison. You add Apple to, for instance, Microsoft, what do you got? You know, like between 11 and 12% of the S&P 500. You realize that just Microsoft added to the market cap of Apple is now worth more than, if you will, the bottom 250 companies in the S&P 500. Realize again, people are still looking at advanced decline lines out there. It's all for nothing. Okay, when you have again mega market caps. With that, again, expect us to channel still inside of the volatility box. A break to the upside from here, yes, could be a little violent, if you will. Nevertheless, okay, as the bonds break lower, that okay could be the stress and the pressure that snaps the S&P 500. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.